Welcome back. We're about halfway through a busy U.S. earnings season with results from big tech doing nothing to slow down the rally in technology stocks. This week, we'll watch for earnings from two more tech giants of the so-called Magnificent Seven. Apple and Amazon.com are both on deck later this week. Let's go to Kash Pashootan. He's our guest right now. He's Chief Executive Officer of First Avenue Investment Counsel. And of course, he's watched the earnings very, very closely. Thank you for coming in, first of all.
Thanks, Paul.
What kind of earnings season has it been from your perspective?
Like you said, Paul, about half of the companies have reported so far. And as we've seen, the story of what's really been the case year to date has continued, which is a small handful of stocks have really led the way. So overall, though, on average, better than expected, better than forecasted. Sales are up about 1.5% more than forecast consensus. And earnings per share is up about 5.5%. Over what was consensus forecast. What's interesting, though, is that, yes, the sales numbers on average are up year over year, but earnings are negative. Mm-hmm. So we're seeing earnings year over year down about 3.7%. So the good news is it's better than forecasted. The bad news is we're not seeing it really where we need to see it, which is in the earnings.
Right. I think the forecast was for earnings to contract by about 9% across the S&P 500, correct?
Yeah, well, not coming into the year. Things were revised as the year went through, but it really is a story of we need to see the earnings grow for the share price to often go up. Now, again, these numbers are on average. When you look at some of the, as you mentioned, Magnificent Seven, they've really been carrying the weight, but that's really been the story year to date. I mean, when we look at the number and we look at the return year to date for the S&P 500, we know that about 85% of that return is coming from 7 stocks, and that's really been the theme here in Q2 earnings as well so far.
What's your take on the guidance? There was all kinds of apprehension about what we might hear from big U.S. corporations about the macro environment and what they see ahead for their businesses.
I think it's important to be prudent here. I think, if anything, now's the time where the market will accept you coming out with some more conservative consensus, because everyone's at the edge of their seat waiting to see if the U.S. is going to go into a recession. So I would be guiding conservatively here, because whenever you surprise to the upside, we know that the market likes that. So if the market's giving you a window here to be conservative in your consensus or in your guidance, I think that you should. And again, let's not forget where Prime was a year ago and where it is now. And so household carrying costs have gone up a lot. And so, at some point that needs to play out. And we know that there's a delay between when Prime goes, let's say, from 2% to 7%. The consumer can absorb that for 1, 2, 3, 4 quarters. But after savings has been depleted, then you start to really feel it. And the consumer has to make some tough decisions of what they're going to pare back on. And we're sort of just starting to see that now.
We're going to speak to Danielle DiMartino Booth later in this program. She believes that fiscal spending in the U.S. has not been dialed back significantly from the worst of the pandemic, and that's really carrying the U.S. economy and the U.S. consumer. Would you agree?
It makes sense, because something has to give. When you have sort of the prime rate, like I said, which is what affects most consumers, go up faster and to a greater quantum than ever seen before, and the consumer continues to show resilience, it's not a soft landing. There's either delay or there's something that is supplementing that. And to your point, we do think that fiscal spending continues to be plentiful, let's say.
We continue to see a very tight U.S. and Canadian labor market. What is that telling us about the possibility of a soft landing?
Well, I think that so this year we started to see some layoffs, and really it started with tech and it's spread really across the board. But as you mentioned, the number is still, unemployment still very, very low. Our view is that employers are making a bet and looking past the recession. I don't think many are naive enough to think that things are just going to be smooth here as we go through. But we just came out of a period where it was so challenging to get high quality people, whatever industry you were in. So if you have high quality people, you may say, you know what, we have more staff than we need, but that's lesser of the evils than laying people off and having to redo it all over again. So many are just going to sit tight and ride this out, knowing that they may be overstaffed for a few quarters.
The big story, or one of the big stories in the first quarter, was the collapse of Silicon Valley Bank and the fear that was in the market for a while of a serious problem and spreading contagion in the U.S. regional banking sector. Has that been resolved? Not everybody believes that it is over.
Well, I think the fact that we saw immediate action and that those that had deposits with the banks did not lose money, I think that is really what's helped mute the concern. Certainly there's going to be some more regional banks that are going to face that sort of restructuring. But again, it's about how fast we act and what the implications are. And I think that as long as we act quickly and those that have put their money into those banks are not losing money, it'll be water under the bridge and we'll get through it. But certainly those spikes will cause volatility. But again, that swift action has helped it not turn into a bigger problem.